Hi everybody, today I'm in the studio with Senior Macro Analyst Darius, and we're here to bring you the 21st episode of Hedgeye in the Arena. Darius was a guest on our second episode, so if you haven't already listened to that, I suggest you go back. You'll find a lot more about Darius's personal background and how he got his initial start at Hedgeye, which was an interesting story, right out of college, and how he's sort of consistently risen up the ranks. We're going to get into the market action, our models, and some subscriber questions. Before we do that, actually, I want to ask a personal question. One thing I noticed over the years, and even more so this year, is you've been adapting your, I guess, time allocation strategy. And one thing you did earlier this year was you really de-emphasized kind of personal social media.
Yeah.
Kind of, I think for some of the younger listeners, just what you've learned about how to allocate your time and what to focus on, what to not focus on. And,
yeah,
that would be interesting.
That's interesting. So certainly, to Daryl's point, I've recently just deleted all of my social media. Primarily because I found that it was becoming sort of an increasing distraction.
Yeah.
And I don't necessarily mean that my own usage, but relative to the sort of total opportunity set of things that I sort of had to work on. I wore sort of a number of hats here at Hedgeye, most prominently being sort of the sort of chief data analyst with respect to modeling and forecasting the global economy on the macro team. But I also run the macro team from a business perspective as well, in the sense that sort of, new business development, sort of client relationship management, understanding trends in the business and sort of being able to forecast sort of the actual business itself and the drivers of the business. So, just sort of having to wear these multiple hats in a growing business, it just made me sort of realize how much time I could be reallocating from every single day. We have this 24-hour time interval every day, and the day is not going to get any longer or shorter from there. How can I reorient some of that time to sort of better meet some of these challenges?
Yep, that makes sense. So getting into sort of the Hedgeye process, we use a lot of proprietary language and models. And I think for some of our users who are relatively new, it's some of what we, in a sense, we create our own language.
Yeah.
So I think maybe going through sort of a step-by-step, maybe an explanation of how we create the model and then, what it does, how we use it. And obviously the big one is one that you're sort of the author of, which is the GIP model. So maybe we start there and you just sort of talk a little bit high level. What is the GIP model and how do we manage and operate it?
Absolutely. So Daryl's referencing our growth inflation policy model, or GIP model for short. This is a regime-based sort of framework to think about contextualizing an economy, particularly where they are with respect to their rate of change cycles in growth and inflation. If you think about growth and inflation, you take a step back from there and say, okay, what are the primary drivers of asset class returns and rotations within and out of asset classes across multiple economic cycles? So that's the first sort of question you should be trying to answer as a macro-oriented investor. Ray Dalio's got 1,500 PhDs at Bridgewater who've all sort of effectively come to figure out the same thing that we figured out, that growth and inflation are the primary principal components of asset class returns. When you start to layer on changes in policy and changes in things like corporate profits, you really start to form a very holistic picture of what actually is determining, interest rates, currencies, equity indices, levels of these sort of major asset classes. We focus on growth and inflation for two primary reasons. One, because those are the principal components. Those are the most important things to get right as it relates to forecasting asset market returns. But secondarily, this is a really important point. Policymakers respond to changes in the levels of growth and changes in the levels of inflation on a lag. And so if you can use a rate of change oriented process, and what I mean by rate of change, we're thinking of everything in differential terms. Is growth accelerating or decelerating? Is inflation accelerating or decelerating? We're not just keenly focused on the levels. Obviously, the levels matter as it relates to forecasting policy, but just focusing on those big changes, because that's where all the price action is occurring in the financial markets that lead central bankers to make these sort of policy pivots or double down on existing policy initiatives. So we're very keenly focused on triangulating all three of those things as it relates to where an economy could potentially be. Do you want to just go into
yeah, so then with the model, I was just going to ask, there are different regimes that we focus on.
Yeah, absolutely. So, slide 6, our macro themes deck, the first sort of 25 slides or so in these quarterly themes decks don't change at all. In fact, they're just process slides that we continuously update. But on slide 6, we show the GIP model. The GIP model sort of, if you take the two factors, growth and inflation, you wind up with effectively 4 scenarios when you sort of slice them into a regime-oriented framework. The first of those scenarios is sort of top left box in that chart is Quad 1. Quad 1 is a situation where real economic growth, year-over-year real GDP growth in an economy is accelerating, period to period, whereby inflation is decelerating.
Yep.
So historically, investors have called that regime Goldilocks in terms of the general nomenclature around Wall Street associated with sort of these types of economic conditions.
And when you talk about accelerating or decelerating, you're talking about the rate of change. So
absolutely. So the percentage change on a year-over-year basis, is that accelerating, i.e. getting bigger or smaller on a period-to-period sequential basis?
Right.
So for example, if growth is 1% in the first quarter and it's 2% in the second quarter, it accelerated by 100 basis points over the course, over the duration of that interval.
Yeah.
So that we're keenly focused on predicting and projecting not only the magnitude, or the sort of the direction, but also the magnitude of those accelerations and decelerations, because again, that's where all the financial market sort of price action occurs in the pricing in of these changes. So going back to the 4 different regimes, Quad 2, top right box in that chart, is when growth and inflation are accelerating at the same time. That tends to be much more sort of hawkish monetary policy dynamic. Investors have historically sort of termed conditions like these reflation or sort of overheating to the extent that you're in a persistent Quad 2 regime, whereby growth and inflation are decelerating on a trending basis.
So that would be a scenario where the Fed often is forced to act, or thinks they need to act.
Bingo, particularly when inflation is bumping up against their sort of policy mandates, which are generally around 2% on core for most of these advanced economies. So that's the hawkish quadrant. That's the quadrant where you typically see bond yields rallying, you see real interest rates rising, you tend to see sort of underperformance of things, more safe haven assets like gold, treasuries, in lieu of sort of much more sort of credit-oriented, equity-oriented asset classes. I mentioned Quad 1 is in fact the best, or at least historically has been the best quadrant for equity and credit returns, but Quad 2 obviously is a close second.
Yep. And then the other two are the inverses of those.
Bingo. So if you sort of draw a Maginot line down the middle of this diagram, this GIP model, what you find is that Quads 1 and Quad 2 are pro-growth. Growth's accelerating in both of these quadrants. It's just inflation is the oscillating factor. Whereas you go to the bottom of the quadrant, Quad 3 is when growth's decelerating now and inflation is still rising. It's still accelerating. That's much more associated with late cycle economic expansions where you have sort of tight labor markets. The just natural growth rate of the economy tends to slow down as both the credit and sort of labor cycles mature, but inflation is obviously continuing to accelerate. The longer the Quad 3-like conditions persist, investors start to use words like stagflation or stagnation to describe that kind of market or sort of economic outcome. And historically, what you've seen is that particularly later in the economic expansions, Quad 3 really starts to sort of become a stock picker and credit pickers market.
Yep.
You don't tend to see big outsized moves in either indices or rates or currencies. You start to see much more middling performance at the index level, at the asset class level, but sort of underneath the asset classes, you have some pretty big divergences as it relates to sort of various industries you can invest in with respect to the equity and credits markets, various currencies within the currency market. So you start to see that kind of stuff sort of play out. But what you tend to note is that credit risk and leverage tend to become really negatively correlated style factors with respect to the persistency of Quad 3 regimes.
Yeah.
And then lastly, this is the one that everyone hates unless you're long bonds and long gold and long the dollar, is Quad 4.
And by long bonds you mean typically treasuries.
Treasury bond, yeah, exactly. Or for any developed market currency or developed market country, you tend to see the outperformance of sovereign debt in Quad 4, as investors tend to rush for safe haven assets or the perceived safety of these sort of so-called safe haven assets. That's an entirely different discussion. But Quad 4 is a scenario where growth and inflation are decelerating at the same time. As you can imagine, that's really negative. That's a really negative economic impulse as it relates to the generation of corporate profits. That's a really negative economic impulse as it relates to sort of just the general sense of the general tone of financial market news. Growth slowing, inflation slowing. There's no outs as it relates to the equity and credit investor. And so what you've seen historically is that the preponderance of real big drawdowns as it relates to equities and credit have historically come in and around Quad 4, either the market pricing in Quad 4 ahead of time or the market pricing in Quad 4 while it's ongoing. If you think about sort of just a broader business cycle, taking a step back, because again, these are quarterly sort of regime-oriented projections that we're trying to sort of nail every single quarter to identify exactly what might change on the margin with respect to trending asset market performance. But taking a step back to the broader business cycle, what you see is heading into recession, at least over the last few recessions here in the U.S., is that they tend to peak out. Cycles tend to peak out in quad three. Again, you get tight labor markets. You're starting to roll down the hill in terms of employment growth and wage inflation, which is a very late cycle indicator in terms of when it peaks relative to the cycle. Then you sort of slow into quad four, and that persistency of quad four after quad four, that is what that's how recessions occur in respect to rate of change speak, with respect to these regimes. As it relates to our process, we don't necessarily care about calling for an NBER business cycle type recession, because again, if we're set up for the asset allocations that the history would suggest you should be in quad four and quad three as well, then you don't necessarily have to make the recession call because you're already in the right types of assets that'll do well.
So historically, our model has actually worked quite well, but in the instances where we've been off either in the wrong quad or maybe the assets sort of didn't move the way we expected them to move in the short term. What went wrong with our model? Or did anything go wrong with our model? Or what was, in hindsight, what was the error, if there was an error?
Yeah, so there's two types of errors that could happen. One, there's forecasting error, i.e. we get the quad wrong. So the most recent iteration of that was probably Q1 of 2019, where initially our competitive base effect model, and I'll take a step back and actually explain how we use this process, because it's not just enough to have a regime-oriented framework, but as it relates to investing, because the market is constantly pricing in future economic developments and future microeconomic developments, you have to have an ability to forecast where we're going in this as it relates to these regimes. So we intra-quarter, when we're receiving data for that particular quarter on the high-frequency data side, and what I mean by high-frequency data are things like industrial production, retail sales, the PMIs, confidence surveys, things of that nature that feed into those models that give us a real-time sense of where the economy is tracking from a year-over-year rate of change perspective with respect to real GDP. And then we run a very similar nowcasting process for inflation, but we use market pricing, things like commodities. WTI crude oil is a big swing factor for a lot of countries' inflation series. Food prices, things of that nature. So we constantly have a general sense of what quad the economy is in intra-quarter. And then from looking forward up to 1 year in the future, we run a comparative base effect model that uses 2-year comp stacks to sort of extrapolate that level of momentum on either growth or inflation into the future, to give us a general sense, a very highly back-tested, a highly accurate sense of how the levels of rates of change, how the rates of change of growth and inflation are likely to sort of progress over the next 12-month time horizon. So with respect to the forecasts that are associated with that, our first initial estimate for any particular regime using a Bayesian inference process is always going to be going with the rates of change in the comparative base effect model. Because again, if you look at it sort of 1 quarter ahead, Q4 of this year of 2019, we don't know anything about Q4 of this year. All we know is that what the current level of growth is, the base rate is for growth and inflation, and we know how the comparative base effect model changes from Q3 of 18 to Q4 of 18. So sort of, that comparative base effect model does carry some forecast error.
Yeah.
For growth and inflation, it's about 75 to 80% in terms of forecasting the directionality correctly, which is really all we're trying to do. Yeah. We obviously want to get the magnitude right, particularly as, if we go deeply into quad 4, deeply into quad 1, because then you tend to see those big outsized market moves when the market's pricing in these huge, massive deltas in the economy in short order. Yeah. So again, there's there's forecasts that are associated with the comparative base effect model ultimately being proven wrong, but then there's also forecast error with respect to how is the market going to treat this particular instance of quad 4, exactly. This particular instance of quad 1, 2, or 3. So again, we're constantly, we don't consider ourselves to be competing with other investors or competing with other macro strategists. We're constantly competing with the market in 2 ways. One, determining what is the market actually pricing in any given interval. Is the market pricing in the quad we think it is? And if not, what quad is the market pricing in? Is it looking ahead, or are we just wrong on this quad projection? So there's a number of different ways you can be wrong, which is why Keith and I and you and all the guys on the team wake up so early every morning to crunch all this data to give ourselves a better sense of how to mitigate that sort of forecaster.
But in a nutshell, what we think we've created is a very good sort of framework or roadmap or weather gauge even for what's happening. And the intention, more so than anything else, is to make sure you don't blow yourself up to some extent, right?
Absolutely, Daryl. You hit the nail on the head. I think risk management, I think Keith would agree. Keith would certainly agree with this because I've learned this from him. Risk management is not about tunning it on the long side. Any broker in this industry worth the cheesy shirt he's wearing or the cheesy tie they put on can get you into something that goes up.
Yep.
Risk management is about not being along the stuff that goes down. And if you sort of layer on exactly how we think about risk management in terms of tying the economy back to the financial markets, it's some of these macroeconomic impulses are proactively predictable. And historically, some of these proactively predictable macroeconomic impulses have created a lot of volatility in certain asset classes. Yeah. So if we can use this forecasting tool to sidestep those bouts of volatility in particular asset classes, we can sort of grow our net worth, grow the net asset value of our portfolios, in a much more sort of risk-reduced manner. Yeah. As relates to some of in comparison to some of the other investors who it's buy stocks for the long run, or if I'm a bond manager, it's buy bonds for the long run. Well, nothing works in the long run if you sort of think about it on a risk-adjusted return basis.
Yeah. So the other key model we use, among other things, is the risk ranges, which is a model that Keith developed to sort of manage risk within a portfolio. So maybe you can give the subscribers a little bit of a description of what that is.
Yeah, actually, before we go to that, there's one final thing I wanted to sort of bring up with respect to the quads, and why Keith looks at certain industry or certain sort of factor exposures in stocks and credits within the context of that risk range process. So if you go back to the quad process, we've back tested every major factor exposure all the way down to the GICS level 4 subsectors within various asset markets or various equity and credit markets to understand precisely how his history has treated certain sectors, certain industries within the economy, certain asset classes going from quad regime to quad regime. So, as I mentioned, quad 1 is very offensive for equities and credit. Quad 2 is very hawkish. Rates tend to rise. Real interest rates are tending to rise. Quad 3 is much more stagflation. That's where you see the maximum amount of dispersion across industries and sectors within the equity and credit markets. And then Quad 4 is really, really positive for the dollar, positive for gold, positive for treasury bonds, risk, sort of quote unquote safe haven assets. And so, having this, to do this properly, you need to have the regime. You need to be able to forecast what regime we're in and what regime we're likely headed to. And then you need to know exactly what the appropriate asset allocations are for each regime to know what to get in and get out of as you sort of as the market starts to price in that transition process, which leads us to the risk range process.
Exactly.
Because Keith, he doesn't wake up every day and run risk ranges on let's call it 15 million different tickers that he could possibly be running risk ranges on across the entire global edifice of financial markets. Yeah. He has a curated list of stocks, credits, bonds, currencies that he's constantly looking at as a function of where we are in this quad process. If we're in quad 4, his risk range is going to be populated with a lot of things, factor exposures that do well in quad 4. And conversely, if we move to quad 1 or quad 2, and that's on the long and short side. Because again, there's plenty of things that go up and down in every single regime. And so to the extent that he's got this curated list of equities, currencies, credits, things of that nature that do well in the regime, he's going to be looking at those. And things that do poorly, he's going to be looking at those on the short side. So just going back to this risk range process, Keith developed, I share this anecdote because Keith shares this in our institutional client meetings all the time. When he first started working in Magnetar, so he sold his fund to Magnetar in the mid-2000s, and it was his first instance with sort of risk management that was more systematic in nature. If you recall, Magnetar spun out of Citadel. I think Leibowitz is the guy who sort of created Magnetar to be very, very systematic with respect to risk management. Yeah. And so effectively, he would find often in his early days at Magnetar that they just risk and neuter him out of being able to take positions. Keith, prior to that, was built his career on making big bets and generating big alpha. But he realized that, hey man, a lot of times these guys come into the room after their risk management meeting and tell me to sell a bunch of stuff that's already on my loan book. And so he started to develop this process at the bare minimum to try to front run these big changes when the risk systems start to spit out things that would be counter to his positioning. So how this risk range process works, he's using a composite of price volume and volatility at sort of index or ticker level to sort of generate a probable range by which a security over a short to intermediate term time frame is not going to blow through. So, for example, you think about the S&P, the stock market. He wants to be transacting at the low end of the range in terms of buying or covering shorts.
Yep.
You want to be transacting at the top end of the range as it relates to selling existing long ideas, or potentially shorting, opening new short ideas. What you don't want to be doing, according to this process and according to this process that he used to front run his own risk managers on the buy side, is just transacting by happenstance. A lot of investors sort of, this is certainly how I initially started investing. When I first started investing, I come up with an idea and I put the position on because I was done with the research. That's precisely how you should not do it. How you should do it is, okay, I have my idea, I have this quantitatively oriented top-down fundamental process that allows me to sort of think about the asset classes and core factor exposures that I want to be long or short. But now let's transact as it relates to minimizing our risk of immediate drawdowns and big drawdowns. Let's transact at these probable points by which we can sort of say, it's very unlikely that this will go down further. Yep. It's very unlikely that this will go up further over some short to intermediate term time horizon, as opposed to sort of transacting how a lot of investors transact, which is emotionally in response to news, or just sort of by happenstance when they finish the research idea. So that's kind of the genesis of that.
I guess what's unique about the risk range is a lot of technical analysts look at price and volume, whereas we add in price, volume, and volatility. So it's almost three-dimensional in a sense.
It's very three-dimensional. It's sort of Keith is constantly measuring and mapping not only the level of realized and implied volatility across each of these asset classes to sort of better understand the maximum thresholds by which these security or assets can trade in a short to intermediate term time horizon. But he's also constantly measuring, mapping the relationship between implied and realized volatility. So one of the things that we've incorporated into that process, that particular process, is sort of looking at the premium or discounted with respect to where the market is pricing implied volatility, front month implied volatility relative to realized volatility, because that's also instructive as it relates to, okay, is this a maximum paying threshold? For example, for something like the SPY, the S&P 500 ETF, when you see implied volatility discounts start to really, and again, we're looking at front month at the money put implied volatility. So this is when investors are actually paying for protection. When the price they're paying for protection starts to get 10, 20%, it starts to show a 10 to 20% discount, even sometimes up to 25 to 30, which is rare, but they happen as recently as this morning or as a Friday night. When you start to see that, it's a big signal that investors are saying, whatever's just been realized, we're through that period of volatility. If you have a view that realized volatility is fundamentally oriented and the fundamentals haven't changed, then you can actually find that to be a very, very interesting price to transact, because it's signaling a ton of complacency with respect to the long side of that. Conversely, you get these high implied volatility premiums start to develop in some asset classes that investors are kicking and screaming and don't necessarily believe in. I think about treasury bonds as going back to Q4 of last year when treasuries start to recover, but investors didn't really believe it. So the investors are overpaying for protection because they think some mitigation of realized volatility is unlikely to be sustained. So that's another part of that process that we've sort of incorporated, and it's very instructive as it relates to timing. Yep. And I do want to pause and kind of talk about timing for a second, because you and I went to Yale, you went to Columbia Business School. Timing is a four-letter word in our industry.
Yep.
Everyone says you can't time markets, and I would take their word for it. Most of these people cannot time markets because they don't have a process that is repeatable, evolved enough, thoughtful enough to help them time markets consistently. A lot of people get lucky, and there's nothing wrong with getting lucky. It's actually one of the core drivers of returns is just luck. We can't do anything about it, so we don't spend time talking about it. But we spend 100% of our time, whether it be Keith's risk range process, the trade trend intel process, which you can touch on later, the GIP model process, is designed to help investors time big shifts in volatility across all of these asset classes, whether they be up or down. Obviously, volatility up tends to be correlated with prices going down, and vice versa. So our entire process is geared towards helping investors time the entry and exits from not only core asset allocation positions, but also some of these ancillary positions and/or trading around those positions, which is why Keith's risk range process is so instrumental as it relates to our signaling and communications to clients.
So fast forward to today, where are we right now in the U.S. economy, and what is the prospect for the next couple quarters?
Yeah, so we're actually a very, very interesting point. I think it's one of the more interesting points I've seen over the past decade, to be honest with you, because on one hand, we're in Quad 4. Quad 4 is really negative. In fact, we're actually probing deeper into Quad 4 as of this morning. We got the ISM data point this morning for manufacturing, which slowed to new cycle low of 49, new orders at 46 handle. That's telling us, it's confirming our view that the U.S. economy is decelerating, and it's being led by a manufacturing slowdown. The same manufacturing slowdown that's plagued the global economy since starting back in the first quarter of 2018. Note, I'll say the first quarter of 2018 because the global manufacturing slowdown predated the trade war. Trade war is obviously a negative impact, or is having a negative impact as it relates to perpetuating further downside, but the horse had left the barn already as it relates to the global economic cycle, and that's obviously spilling over into the U.S. economy. So we're in Quad 4 now, getting deeper into Quad 4 as it relates to the most recent data, the August data that we got this morning. But the model, the comparative base effect model, says we're going to bottom out in growth and likely accelerate it in the second part of in the fourth quarter of this year, and sort of stabilize at around 2.5% year-over-year real GDP growth.
Yeah.
Now, that's a real interesting setup because when you sort of look across financial markets, if you look at the sort of trending performance underneath the hood, not at the equity index level, but sort of if you look at style factors, things like high beta, high short interest, high debt, those sort of more cyclically oriented style factors have been crashing. Some of the, look at the chart of the retailers, look at the chart of the transports. Some of the, relative to something like the utilities, REITs, look at something like consumer staples. The market has been pricing in, or at least investors have been sort of getting incrementally defensively positioned with every week, every month since this sort of Quad 4 view emanated. And you're starting to see that, you're not starting to see that, you're continuing to see that, particularly in the rates market. I mean, you look at the Treasury curve, it's pancaked on 10s 2s.
Yep.
10s 3s, 3-month T-bills are minus 50 basis points. So the market is saying the Fed needs to cut, and the Fed needs to cut in a hurry and do a whole heck of a lot as it relates to sort of uninverting the yield curve. They're probably going to do that in a few weeks on the meetings on the 18th. So will that monetary easing by the Fed, and this is why I say we're at such a critical crossroads, because this is the first persistent Quad 4 we've seen that's also late cycle as it relates to the business cycle.
Right.
Jobless claims probing lows of 200, let's call it 225 to 250,000. Sort of the labor market, if you look at the level of unemployment, the most important signal we glean from the labor market is looking at the spread between the U6 rate and the U3 rate. Historically, when that spread is below 350 basis points wide, you tend to be very late cycle with respect to the economic expansion. We're somewhere around 320, 330 basis points wide now. You don't really get much tighter than that. Now it's all about, once you get to this level of tight, how long do we have to the actual business cycle rolls over? And so going back to the point I made about this being a really critical juncture, we have all these exogenous shocks as it relates to trade policy and just sort of global economy really, really sucking wind. And we're finally late cycle with respect to employment. If we get another big exogenous shock, and who knows what they may be, they're exogenous for a reason, do we actually recover into Quad 2 in the second quarter or in the fourth quarter of this year? Does the economy actually stabilize at around 2% year-over-year real GDP growth for the next few quarters, which is what our model's projecting. Yeah. But you can see it in pricing, and you can see it in the data that may not come to fruition. And so it's the first time where you're sort of saying, okay, we've got one more month in this particular regime. And I didn't even mention corporate profits. We got Q3 earnings are going to be the worst we've seen of this cycle. Q3 earnings get reported in October and November. So you got the worst data as it relates to Quad 4 over the next couple of months, through at least October in terms of reporting. And then you have Q3 earnings, which will start in October and bleed into November. So you have all this negativity, but then you have this sort of positive or marginally positive Quad 2 outlook in Q4. The market is not pricing that in. And so I'm a little worried as it relates to the health of the U.S. economy, because if the market doesn't start to price that in on a 1 to 3 month forward time horizon, it's telling you that's not going to come to fruition. Yep. It's telling you that there's something worse on the horizon that you might not be able to see yet in nowcasting terms, but it could potentially be coming. So this is why we spend so much time sort of, if you will, separating church and state.
Yeah.
Keith is sort of, I don't know whose church and whose state, but if you think about this in A/B testing terms, the A is what quad are we in, what quad are we likely headed to?
Yeah, and then what the assets are going to do in that quad.
Yeah, and what the assets are likely to do in that quadrant, or at least what they have historically done. So this is how we want to think about being positioned. But the B side of the A/B testing is the market saying that's correct or not?
Right.
Is the market confirming that view? And if the market is disconfirming that view, what view is the market confirming? And what is the probability that the data actually evolves in a way that we can sort of support chasing what the market is effectively doing from a trend following perspective.
Yeah.
And it's very clear that the market is not pricing in any sort of recovery into quad two, neither domestically nor globally. Whether you look at interest rates in Europe or you look at equity indices in Asia, just the dollar itself, the dollar is on a tear. It made a new high recently. And so all these things continue to signal to us that we're actually getting deeper into quad four, and that the probability of those twos manifesting in 4Q, both domestically and globally, quad twos rather, that probability is sort of low and or falling.
So maybe the next thing would be just to break this down further into idea generation. And as an example, maybe we can use TLT, which has been a very good call for us. But how does it all come together to make a convicted call? And if we go back to when we, I think, had a contrarian call on TLT or treasuries generally, what brought it all together? Just combination of GIP, risk ranges, levels, and then we sort of stood out there against the grain to some extent and made this big call.
Yeah, no, it's certainly one of the bigger calls we've made as a firm, really, and not just on treasuries, but just that quad 4 and Q4 call last year. The equity market effectively crashed. If you think about the stock market, S&P 500, Russell, NASDAQ obviously did crash. And then interest rates, began a process of effectively getting cut in half, and getting cut in half further from there. Or it looks like they could potentially be on the way to getting cut in half further from there. I'm not saying that's going to happen, but it certainly looks like it's not an inconsequential risk. So going back to how do we think about making those calls and what gave us the conviction to make the calls, and it's just a process. It's the same. We execute the same, much like an athlete would. We execute the same exact process. So you go back to the A/B testing. The A/B testing said the U.S. economy was starting to slow from its mid 2018 peak. You pick your indicator. It was you saw the first degradation after 8 consecutive quarters of acceleration, which was a new U.S. record on a year-over-year rate of change basis off the mid 2016 lows. We accelerated for 2 full years, persistently quarter after quarter. Our nowcast model by the end of the third quarter was signaling some of these data points were starting to slow as it relates to some of the underlying high frequency data that build into those frameworks. But more importantly, we're starting to slow into a dramatic acceleration in comparative base effects. And so historically what that means is that it's a borderline slam. I hate to use the word slam dunk because there's nothing as a slam dunk when you're forecasting, because we're always dealing with futures and probabilities. But it was a borderline slam dunk call to say growth and inflation are going to slow in Q4 because we're already slowing now against easier base effects. Once these base effects really jump like they did for both growth and inflation in the fourth quarter of last year, then you really started to see that persistent deceleration start. And so it not only was it just the quad 4 occurring, it was the quad 4 started to occur after this persistent string of quad 2s and quad 1s. It was mostly quad 2. We had 2 quad 1s during that 8-quarter run, but it was mostly quad 2. So the latent positioning associated with just being short treasuries, being short of duration risk, being long of cyclically oriented sectors and style factors within the equity and credit markets, there's a lot of latent positioning associated with that persistency of the economic momentum. So of course, with that latent positioning, you have the entire world short of treasury bonds. And one of the things we really look at as core to our process as it relates to identifying where the buy side might be positioned, or just generally identifying investor sentiment, we look at net non-commercial futures and options positioning within the CFTC commitment to traders reports.
Yep.
Why we track that is because it's non-hedging activity. It's what speculators are positions, the net length of positioning that hedge fund investors are putting on because they have a fundamental view on some sort of outcome. Not everyone has our quads or our process, but again, everyone can figure out what they do to get them long or short treasuries. What you saw was that across the curve back in sort of September of last year, September even into October, the market was as short of treasury bonds across the curve as it ever had been.
Yeah.
This is in nominal terms. This is in Z-score terms. We track everything on a 1 and 3 year Z-score basis. Typically what you see, just sort of taking it aside here, what you tend to see is that sort of asset markets tend to sort of inflect from a trending performance perspective when the positioning gets too crowded in one way, and one of the ways we track crowdedness of positioning is through 1 and 3 year Z-scores. So you're talking about Z-scores, 1 and 3 year Z-scores, 2, 3, some cases even 4 in certain parts of the curve. Everyone's super short euro dollars, everyone's super short treasuries off the curve, but we're saying, hey man, quad 4 is not only the most likely outcome, we're walking into quad 4, we're coming out of a bunch of quad 2s, and it's going to be a pretty deep quad 4. So to us, that gave us a lot of confidence in saying, okay, the market, we think rates are done going up here. Yeah. Certainly if they continue to go up, it's not going to be at the same pace. Because again, you had this sort of, there was another discussion that last in 2018 with respect to bond yields and where bonds were going. There was this whole discussion on the U.S. debts and deficits, on the de-dollaration of the global economy, and how that would lead to reduced investor demand globally for treasury bonds and U.S. dollar denominated assets. So that was another part of the view as it relates to consensus, or why consensus was so short of treasury bonds. Yep. And why they were so wrong being so short of treasury bonds at that particular interval. So we had that view that none of that stuff matters if the cycle slows. These things all sort of are great, all this sort of non-time series oriented analysis. They're great to have, fun, colorful discussions on television with some of these sort of old wall talking heads. Sorry, my apologies. We call the
Yep.
sort of legacy Wall Street the old wall. We like to think that we're some version of the new wall here. But anyway, those things are colorful data points, and they're colorful, but they don't necessarily drive asset returns. What drives asset returns are the rates of change in growth and inflation. You can look it up, you can do the principal component analysis yourself, you can take Daryl's word for it, you can take our word for it. Yep. If the rates of change of growth and inflation slow into quad 4 for the first time in over 2 years, bond yields aren't going up. And so that gave us a lot of conviction to make that call. And once you start to see bond yields really break down and bond prices start to break out on key quantitative signals, using this trade trend tail process, which is sort of a measure of trending momentum on longer durations, or even the risk range process, looking at the immediate term trade, which is a measure of momentum and where security is likely headed out of shorter term duration. Once those ducks lined up, you got every single component you could ever possibly need to make a big call. You got the fundamentals behind you in your favor, you got positioning on the other side of your fundamental view, and then the market is starting to confirm that price change. So it was a very classic sort of bearish to bullish reversal in bond prices, very classic bearish to bullish reversal in gold, very classic bearish to bullish reversal in bond proxies and things like housing that are more interest rate sensitive sectors, and the rest is sort of history.
Yep, okay, that's great. So we're running short on time, so we're gonna do a little bit of a rapid fire question, including some personal ones.
Huh, cool, why not?
First one's more business oriented, but what do you think investors are missing most right now?
What do you mean missing? I'm not sure if I know.
Or I guess, is there something, maybe the question's better asked, what's most consensus right now? Or, when
I think what's most consensus now is the lack of, the level of disrespect for cycles.
Right.
Every time you turn on the financial old wall TV or listen to a podcast or just, if you're absorbing any sort of financial news media content and some of the research content associated with some of the strategists and analysts that they have on, it's always about these sort of one-off events. This is the trade war, this, the trade war, that, it's the government shutdown. It's just this gross disrespect for time series.
Right.
We like to say that, macro tourists swing from headline to headline.
Yeah.
The boys at Hedgeye swing from time series to time series.
You see that today, in fact. Right?
You see that today, absolutely. So, you see this all the time, right? Yeah. Economic data gets reported, and it's not even in time series for it. It's just some random data point out of thin air. Yeah. Well, it doesn't tell you if it's accelerating or decelerating. It gives you historical context of where it might be within its own cycle. Yeah. And that's all the work we spend so much time doing and so much time staying abreast on, because to us, those time series are what's driving the boat. Now, something like the trade war could obviously have a depressing impact on growth and inflation, but it's having a depressing impact in the context of a time series. Yeah. And so trying to identify where you are in that time series is the most important sort of job you can be doing as a macro-oriented investor. sort of it's understanding and acknowledging that things like trade wars, et cetera, exist. But what are they doing to the time series that drive asset class returns? So to me, that's the biggest thing that everyone's missing is just this adherence to obeying and respecting the cycle.
Right, that makes a lot of sense. Favorite asset classes on the long and short side outside the U.S. So what do you like as a long ex-U.S. and what do you like as a short ex-U.S.?
Yeah, so that's a really difficult question now because much like I highlighted in with respect to the U.S. model, the global economy is deeply in Quad 4.
Right.
It's just it's the data globally is a lot worse than the data here in the U.S.
Yep.
Both are in Quad 4. So what that tells you is that there's not a lot of stuff to buy.
Yep.
With respect to equities or credit. Certainly not EM, local currency bonds. To the extent that you have a positive view on the dollar. That's probably, that's the dollar and gold in Quad 4, both domestically and globally, are two of the best places you can be. And this is across asset classes. So that sort of suffices because there's just not that much other stuff to buy.
Yep.
You can buy European sovereign debt because, again, their Quad 4 is even deeper and more persistent. And again, these are calls we made going back to the beginning of 2018. Yep. We've been bullish on German bonds since the first quarter of 2018, been bearish on the euro, bullish on the dollar since the second quarter of 2018. So these are not new calls. We're just saying the time series is still pointing in the direction that I should be maintaining this positioning. As it relates to on the short side, I mean, again, you look at commodities, you look at Asian equities, you look at European equities, you look at European financials. They continue to make new cycle lows every month because the data and the cycles themselves continue to make cycle lows every month. So again, there's no change to those views. I mean, we've been bearish on European financials since 4Q17. Who else had the bearish call on European financials in 4Q17? Ray Dalio, the same guy who says growth and inflation are the tail wagging the dog with respect to asset market performance. Yep. Again, so that's it's not necessarily trying to come on the podcast today and give investors this sexy new call, this big shiny thing. Gold is a shiny rock. I enjoy gold.
Well, the answer could be that there's not a lot to do globally at this moment.
Well, no, there's a lot to do. It's just not necessarily new.
Yeah.
The cycle has been slowing globally since the beginning of 2018. We've been slowing domestically since sort of the latter part of 2018. Yeah. So none of this is new news. It's just that this is where you would be if you woke up today out of a coma, or you're a brand new investor, transposed in time. That's a more polite way of saying that. If you would just be putting on the global and U.S. Quad 4 views and worrying about the potential transition into Quad 2 domestically and globally at some later interval. Yep. We think that later interval, as it relates to calendar catalyst, is at the earliest on a potential 50 basis point rate cut out of the Fed on the 18th. Yep. But it's very unlikely, because of how inverted the curve is, it's very unlikely that it will even do enough. And so we're talking about going into October Q3 earnings season. Don't forget, Brexit's also a catalyst at the end of October. So you have a lot of things that are sort of lining up against sort of front running our process and trying to get to a more quote unquote favorable quadrant setup in the back half of the year. That just isn't happening yet, and we don't expect it to happen anytime soon until we get through some of these catalysts.
All right, favorite vacation destination?
Oh, probably Montauk.
Montauk.
I've been
called. Some good times out there this summer.
Yeah, absolutely. I always do. I'm from the West Coast, so I'm used to growing up in and around the beaches and just sort of kind of living the sort of Hawaii, California lifestyle. Yeah, and so Montauk is a very, very beachy West Coast town that I really enjoy spending time in. I've been as recently as this weekend by two separate people in two separate occasions was called the mayor of Montauk. So I wear that with pride.
There you go. Favorite musical artist?
Oh,
is there one?
Well, my favorite musical artist is a hip hop artist named Cameron from Harlem, New York. But my favorite music, and this is not necessarily one artist, but it's sort of late 90s alt rock. If you think about the Goo Goo Dolls, the Bare Naked Ladies, and the Third Eye Blinds of the world, I think that music is increasingly, as we move forward in time, is becoming more and more relevant as one of the best genres of music ever, because it's sort of encapsulated. It kind of died, and so now you hear all these new songs and they're not that great, and so it makes all these other classics so much better. So I really do enjoy listening to that music a lot.
That's good. So last question, if you could give a young person starting in the industry today some advice, what would it be? And that's a broad question, because the industry means a lot of things, but I guess wanting to come into finance and into investing. Yeah,
this is probably the same advice I would give to anybody doing anything. It's there are no shortcuts in life. You know, Keith makes this joke all the time that he is one of the lowest SAT scores at Yale. I'm certainly in that category as well. You can't get good at something by just waking up and being good at it. Yeah. Whether it be on the ice, on the field, in investing, you know, there's no substitute for getting up. Keith wakes up at 4:30. I wake up at 5 every day. You know, you're up early as well. Like, there's no substitute for just doing the work and waking up early and grinding with a capital G harder than all the rest of the guys. Because at the end of the day, you know, everyone particularly in finance, you know, everyone you talk to in this industry is brilliant. Everyone's brilliant, but no one knows the future. So even the most brilliant person knows less about the future than the least brilliant person. And so the opportunity that comes along with being able to just wake up every day, grind, and try to get to the right answer faster than the quote-unquote most brilliant guy in the room, you know, that's a fantastic opportunity for anybody. So I would just think like that grind process, it sucks sometimes and you're very tired and you need a lot of coffee, but there's no shortcut, there's no substitute.
Great. Thanks for coming on, Darius. Really appreciate it. Thanks everybody for tuning in.